is the day, the launch of the Africa Green Bond Toolkit. The development of the Africa Green Bond Toolkit was an initiative sponsored by Financial Sector Deepening Africa and prepared by the Climate Bonds Initiative. My name is Anele Makwaza. I'm the founder of Igugu Global, and I am happy to be your moderator this morning. I think ahead of kicking off, we will give it another moment or two for our over close to 300 strong audience to join us. And then we will open the proceedings of this morning, which we will wrap up promptly in an hour's time. So ladies and gentlemen, if you'll bear with us for another moment or two as our attendees fill the room, we'll begin shortly. The Africa Green Bond Toolkit. We will be kicking off promptly at 11:05 South Africa time. We're just giving it another 2 minutes for those who have registered to join us. Thank you very much. To the proceedings of this morning, the launch of the Africa Green Bond Toolkit. The Africa Green Bond Toolkit was sponsored and led by Financial Sector Deepening Africa and prepared by the Climate Bonds Initiative. FSD is a specialist development agency working to reduce poverty and strengthen financial markets across sub-Saharan Africa. The Climate Bonds Initiative is the world's leading organization working to mobilize the largest capital of all, 100 trillion in the global bond market for climate action. CBI works with investors, issuers, developers, and banks and regulators to develop green bond programs across 6 continents, including Africa, where the CBI has been instrumental in supporting the development of green bond programs in Nigeria and Kenya in partnership with the FSD. So maybe to push us off this morning, we have a very diverse audience, many friends and colleagues in green and climate finance, but also many issuers and investors and colleagues that have been involved in the green bond issuing process, and many that are yet to be involved. So what is a green bond, ladies and gentlemen, and why are we here today? A green bond is a debt instrument that is typically issued by corporates, so banks or private sector, non-bank corporates, as well as governments and quasi-government entities to finance or refinance projects. So the newer members in our audience today might be wondering, what is it that makes this difference? And what distinguishes a green bond is the use of proceeds. And this is outlined in the green bond principles. This use of proceeds is understood to be the allocation of funds specifically to projects that have environmental benefit. And this environmental benefit, ladies and gentlemen, is understood to be intrinsically linked to the social benefit as well. And that is what a lot of this morning's conversation is really about. For a little bit of context, up till 2019, we had seen the largest issuance of green bonds to date. Africa has been a growing player in this spot with new issuances in the last year from Kenya that not only increased the number of African players in the green bond market, but have taken a slightly different direction in how Africa comes to market, and the technical advisory that CBI and FSD have provided have very much come to build the story and the lessons that are inculcated in the toolkits today. So in 2020, after the very successful 2019, the year opened on a very turbulent note in terms of climate across the board, from fires in Australia and closer to home, a plague of locusts in East Africa has since translated to floods in Sudan. But most importantly, our attention during the course of this year has been on the coronavirus pandemic. And that health crisis, ladies and gentlemen, has accelerated the focus that the Green Bond Framework had already begun on the environmental, as environmental issues and social issues have continued to converge in how societies respond and build back in the COVID moment. So we continue to see oversubscription in the African markets that are coming to the party. We continue to see benefits that we will discuss today, but also this is a conversation about the opportunities that issuers and investors need to begin to zero in on as we move forward and continue to build this market. The end user of this toolkit is very much everyone involved in the ecosystem. And I think this is exactly this webinar today, this launch is intended to coalesce the lessons from East, West, and Southern Africa in creating a new value of language, a value of language in how we communicate with global investors and invite you, the end user, to be part of that conversation. I think I'll pause right there and invite the organizations that have made today possible, the creators of the toolkit, FSD and CBI. We have with us today someone that really needs no introduction in the green finance and climate finance landscape, Ms. Justine Lee Bell. Justine has spent much of her career helping business leaders, governments, find solutions to the global challenges of climate change and sustainable development. She has provided advisory services for a number of institutions and governments across Europe, India, most recently Latin America, and she is the Deputy CEO and Director of Market Development at the Climate Bonds Initiative. I also would like to very warmly welcome, representing the sponsors of the toolkit, FSD, Vimal Palmer, who's a Senior Capital Markets Specialist at FSD Africa, responsible for leading, managing the implementation of financial market development initiatives across sub-Saharan Africa. He leads the execution of these strategies for strengthening Africa's financial markets for the FSD. So without further ado, Vimal, I'd like you please to introduce us to the toolkit and your initial response at today's launch, please.
Thank you very much, Anele, and thank you very much all the participants for joining this launch for the Africa Green Bond Toolkit. I think there's a very good introduction that Anele has given, so I'll keep it to the Green Bond Toolkit and why we decided to develop one for the African markets. Just as a background, as we all know that the AU Agenda 2063 has been focusing a lot on domestic resource mobilization. And there's also been diminishing traditional financing sources, especially if you look at the ODA flows. There's also some kind of shift or graduation, if we may call it, from the international donor aid, meaning that there's more reliance on commercial financing, especially in a market right now where the Eurobond markets are not so predictable. And also there's also a lot of emphasis on local currency borrowing. So the Green Bond Toolkit, as Anel has mentioned briefly, is mainly a guide that is being developed to provide African capital markets and the stakeholders on how to issue a green bond, which are in line with international best practices and standards. It can be used by all kind of stakeholders. So it's not only for issuers, but even advisors who are in this space. It can also be used by governments who are driving their green agendas and also looking at sustainable development or projects. And all these can also be financed using green instruments, and green bond being one of them. Why is the green bond different? I think Andela mentioned it very clearly, but the a major contributing factor to a green bond issuance is better governance and transparency, because it involves identifying assets or projects prior to the issuance where the use of proceeds will be going. And then every year or annually, it can even be quarterly or half yearly, depending on what the issuer prefers, on reporting of those assets. So mainly on three things: is how the funds have been used, whether there are any changes in the projects, and also what is the balance remaining that still needs to be put into the project. So it provides a backdrop to the development of market and the features which have emerged out of Africa, especially looking at the development. We're looking in the African markets. Africa is a continent which has been blessed with so many resources. However, financing has been a critical challenge, and green bond is one of the best ways which provides that channel and also attracts investors, because now it enhances better transparency and governance for not only issuance but also investors, better pricing in the market depending on the credit rating agencies or the credit rating, and also verification of the assets even after the issuance, to make sure that the use of funds have gone to the right projects that were initially targeted for. So that is basically a small introduction of why we have done a green bond. It uses various taxonomies. It can also be classified as an SDG bond because you're basically financing social and environmental projects. And these are aligned, and they contribute to the achievement of the SDGs that we have seen. I think with that, I will let the other discussion on why the green bond is beneficial or what are the opportunities come out in the panel discussion, which Anele will be moderating. So Anele, over to you.
Thank you, Vimal. I think you touch on several issues that I hope our dialogue will break apart during the course of our hour together today. Namely, you highlighted Agenda 2063, which speaks to the coalescing of how the region wants to communicate with investors. We see this via the free trade agreement, as well as other movements made by finances regionally. But this is an important point that I'd love to invite Justine to maybe open up the conversation for us in terms of the global investor dialogue, in terms of, Justine, what makes this moment so important? On the one side, the coalescing of the Africa investor agenda, but at the same token, happening at a moment where we face a new crisis. Public balance sheets are stretched, and Africa needs to formulate a response that again leans on public debt, but hopefully this time more so on the private player as well. But can you, Justine, maybe open up with a little bit of the importance and the timeliness of this moment, and the CBI's role in keeping the African aspect of framing the conversation global?
Thank you so much, Nelly. And just to say, fantastic opening remarks. Thank you for setting the scene for us. And of course, Vimal, this is a very important piece of work that speaks directly to the African continent, a one-stop shop for anyone in the financial markets, in the governments, in corporates, in the banking sector that are interested in understanding more about how to engage in this market and what sort of the rules of the game and the process, which is exactly what the toolkit is trying to accomplish. Of course, to your points, Anele, I think, the crisis that we're currently enduring globally, this global pandemic crisis, offers a very unique opportunity that in former global crises, if we go back to the 2008 global financial crises, we didn't have the momentum around sustainable finance like we do today. And so understanding where the new sources of capital could be and connecting the investor base back in 2008 was challenging. Sustainable finance was really like in its infancy, if at all existing, to the extent that it is today. And so with the momentum and the scale at which we have reached, particularly if you look at the green bonds market, it says we've got an opportunity here, okay? So stepping back, if we give a bit of historical view for our listeners today, for many of them that are new to this new market, I will say not a novelty. We tend to think of green bonds as being this special product that it sits outside of the normal ways in which bonds operate. This is not a market that has been built on sentiment. This is a market that's been built on risk and addressing and managing and mitigating risk. And that is why we see the successes to date. So we've gone from, in the year of 2012, 2013, around 3 billion USD of issuance, which was essentially a few examples of labeled bond products that the development finance institutions, European Investment Bank, World Bank had put into the market, of which started to get the attention of large-scale institutional investors, primarily in the Nordic region, but in other areas of Europe and the US, where these institutional investors had been looking very seriously beyond the normal financial risk assessments that they do, and started to look at the non-financial. And when I say non-financial risk, we're looking at what is now really being coined around ESG, environmental, social, and governance risk. And, lots of attention was being put in this. And over the decades ahead, we had investors that started to recognize that there was a serious issue, climate change being the largest risk that they were exposed to. And that this started to become a fiduciary duty. Remind you that this is our pensions, right? And making sure that the long-term horizon is being accounted for. And so green bonds served as this perfect product where you had the same risk reward profile as you would with any normal vanilla bond product, except for two factors, as we've mentioned today. Is the use of proceeds. What is being financed? And here you have 100% eligible projects and assets that are contributing to climate change solutions. We're looking at anywhere from energy systems, transport systems, water systems, land use, IT. Every major sector of our global economy has deep decarbonization opportunities to be had. And so it's transitioning those sectors into what we're calling a green economy. And so the other side of it is the transparency and disclosure. And this really was a selling point, particularly coming out of a crisis of 2008, which was anything but transparency and disclosure, right? So investors also increasingly became attracted to the fact that they knew where their money was going, because the issuer's commitment is to report on the management of those proceeds, the allocation of those proceeds over the lifetime of the bond, okay? So what's happened in the last decade, really, and we've gone from now 3 billion to over 800 billion USD globally. That's phenomenal growth for a market that really 5-6 years ago was sitting, at very low numbers. And the demand that is happening is because this makes sense, that there's not a sacrifice for return. And at the same time, you're getting a bonus feature to your investment, which is contributing to climate change solutions and other environmental and social issues. So, just to sort of come back to our current state of play, what the pandemic has taught us is that globalization is got a need to evolve. It's a weak approach that needs evolution and development. What it exposed is our risk of having any shock into the system. An immediate shock like the pandemic has broken down our supply chain systems. It has exposed the lack of resilience in our infrastructure that comes with having such an impact. And I think that investors began to draw parallelism to, if we can't handle a COVID pandemic and the shock that comes with that, how the hell are we going to be able to deal with the urgency of climate change, knowing that that's already in the system? So I think that's very much the state of play today. And therefore, what we've seen in the market is that green bonds are continuing to hold their own. The demand has not gone short. If anything, it's insatiable. And that in itself brings a lot of benefits and opportunities, particularly to governments when looking at how to put in the appropriate recovery stimulus plans. So let me stop there so that we can take the conversation further. Thank you, Nelly.
Yeah, Justine, I'm thoroughly exhilarated by everything you've said. I want to pause and invite our almost 100-strong audience to drop questions in the Q&A. Justine's just opened very boldly by saying, this is not a novelty, ladies and gentlemen. This is a market built on risk. And today we're having a conversation about the opportunity that all of that has created for the green bond market. We are facing all across the world, and particularly today, operating in a context where there are drivers of change that we believe will continue to support the green bond market. Technology is one such driver of change that speaks particularly to how much the market has moved and how much we've been able to do around reporting and disclosure. This is a driver of change that continues to support, as we get the theme of smart technology and monitoring devices, continues to support real economy players interested in engaging that process that begins to enable them to engage investors in green and social instruments in a way that makes the monitoring and reporting and the transparency of the instrument a lot simpler. But this is just one driver of change. And Vimal, I want to turn to you to talk about some of the other drivers of change. I mean, in particular, we opened up by referring to the public financing gap, how governments are under pressure to ensure a low carbon and green recovery, particularly as the cost of the COVID recovery is predicted to cost between 10 and 15% of country GDPs. Governments are very much in a moment of making long-term decisions, and the investor community, as Justine has shared, is very much invested or interested in seeing that these are climate-aligned responses. So the drivers of change that also play heavily into this space are the rise of renewables, increasing resource efficiency, and on the African continent, the stories around cities of tomorrow. The IFC has already identified a north of $2 trillion, $24 trillion market in green buildings, Vimal. You're someone based in Kenya, working closely with governments and private sector players. Can you tell us a little bit more around the opportunities that are emerging out of East Africa and more broadly across the continent for green bonds?
Thank you, Annele. So just to emphasize on Justine's point on the demand, the OECD estimates that there's a gap of $7 trillion up to 2013 that needs to go into climate or green bonds. And that's a huge gap. If you look at the latest statistics that we have in terms of sustainable debt issuances in 2019, green bonds it's been about 810 billion have been issued, while public green finance is at about 330 billion. Yet, in terms of climate assets, we're looking at $97 trillion, which are still available to get funding through the green instruments. So why is the green bond market, being so attractive? So far, we have seen many green bond issuances globally and even in Africa. but it keeps on, the demand keeps on surpassing the supply. And one of the major reasons is that to investors is it not only provides financial returns, but it balances it with environmental benefits, because you have projects which are already tied to the green bond issuance with environmental benefits. With the new guidelines coming on in the investment policy statements, you know, it also satisfies the ESG requirements and the green investment mandate, which most of the investors globally and which are focused on frontier markets or Africa markets are having in their policy statements. As Justine also mentioned, risk management has been very key. It can enable hedging of climate policy risk or stranded assets when you issue a green bond, because of the higher governance and reporting requirements and the use of proceeds, and how the management of proceeds is actually being done is very clear. And all issuers have to report that, because without that reporting, the issuance is no longer considered green, and it can not satisfy the needs of the investors who have invested, especially in the assets which were identified prior to issuance. Another key thing also, and this applies both to investors and issuers, it has high reputational benefits. So as an investor who has a portfolio and you have invested in green assets, you know, when you're marketing your portfolios or your funds, seeking for additional funding or additional capital, that is a very good selling point. And the same for issuers, because now you're showing a leadership that your institution or your country is taking on sustainability or climate or green finance. As I mentioned, you know, transparency has been really the cornerstone of green bonds. It improves a lot of transparency and also enables engagement. If you look at the normal conventional bonds, yes, the issuance is done, but we don't really know where the use of proceeds are going, which has been a challenge in the recent days. So that's on the investor side specifically, but also the opportunities lie to the issuers. And why is it beneficial to the issuer? If you look at the pension assets in Africa, Nigeria being leading on it with more than 30 billion in pension asset base, followed by Namibia, then Kenya, Egypt, Botswana. We are looking at green bonds providing a potential lower cost of capital, because when we see the demand surpassing the supply of the green bonds, you are going to see tightening of yields, which is being brought about by oversubscriptions. There are some green bonds which have actually been issued at par, while others have been issued at a discount. So that has been a really good selling point to the issuer, because you know you're financing it probably at a lower cost of capital than you would have to a conventional bond. It also allows the investor to have a diversification opportunity, you as an issuer issuing it, because now you have the ability to meet your IPS requirements or ESG requirements through the investment in a green asset. Of course, there is the stickiness. Typically, the green bond investors, so far we have seen, they're investing for the long term. So we see investors sticking to the investment and even growing if there are further opportunities which come. And there's also high level engagement, not only at the bilateral company or the issuer level, but also at other stakeholder level. And we're looking at sovereign level regulations, as well as private company level. So I think in terms of opportunities, it provides a lot of opportunity. There's increasing demand for green issuances or green instruments in the market, especially green bonds have been taking the lead since 2013, when the issuance was pretty small, but we're looking at it increasing pretty fast. Also from a pension fund perspective, if you look at the asset allocations, for instance, in the Kenyan case, about 40% of assets are invested in government securities, then the 37 or so in equities. So there's a lot of demand for fixed income assets, and green bonds fall into that. The same case with Nigeria. Nigeria has almost 70% of their pension assets which are invested in fixed income securities. For the credit profiles, depending on the credit quality of the issuer, and given it being a green and proper governance provide a lower cost of capital, I think stakeholders perceive and want to be linked to better governance and management when it comes to investments, especially when they're reporting to their clients. And this provides them with alternative pools of capital through the green bonds. So pension funds or insurance companies or even high net worth investors can now invest in an asset class where they know where the money is going, what level of risk, which can be managed or it can even be hedged, depending on the type of issuance that is coming to market. So I think those are the key opportunities both on the demand and the supply side when we look at a green bond as an asset class for investment. Anele, over to you. Thank you.
Excellent. Thank you, Vimal, for touching to the unique benefits across the demand and supply side. And when I reflect on that, it just again hones in focus on the importance of the toolkit, which becomes a conduit that brings both the capital demand and the capital supply side together in defining the language of value. An important aspect of how this is done is guidance around the selection and evaluation process. Vimal, you also touch on the number of African governments that are excited to use this as a tool to communicate with external investors. Perhaps I'd like to invite Justine again at this point to come in and maybe give us a little more rigor into how that has gone for yourselves as the Climate Bonds Initiative, an institution that's been I don't think it's an understatement to say very closely involved in the issuances of all of Africa's green bonds to date. How are you helping investors and issuers work through the selection evaluation of projects and then the monitoring as well?
Thanks, Aneli. Yeah, I think let me start by sort of saying how this has all come together in the first place, because I think in 2014, an instrumental piece of work came into the market headed by the International Capital Market Association, ICMA, and they put in place what was referred to as the Green Bond Principles. And this lays out very clearly to an issuer the process, essentially, on if you're going to issue a green bond, what is expected of you as an issuer. Very light touch guidance that was important because the market needed some direction, right? If we didn't have the direction in the market, then we'd have a lot of self-declared product that really, at the end of the day, probably wouldn't be delivering anything on climate. And most importantly, we would probably lose that transparency and disclosure element without having very clear reporting rules in place. So it was a chance to immediately benchmark the market. And simultaneously, the Climate Bonds Initiative had put in place two very important pieces of work. One is the standards framework, which encapsulates the Green Bond Principles into an assurance standardized framework that can be verified by an appropriate verifier. And second was the taxonomy. So the standard very much looks at the process and makes sure that there's an assurance model behind that. And then the taxonomy, think of it like your catalog for the opportunity. Across all the major sectors, what are the key green investments that investors are looking for? And what do they expect that in some cases, some set parameters that need to be met in order for them to invest. So for example, if we are looking at energy efficiency, upgrades, or any kind of projects within the built environment, of course, how do we ensure that energy efficiency is actually being achieved? Okay, so there might be some metrics associated with that to make sure that we're operating within the appropriate parameters for achieving those goals. And this, of course, is very much what the investors are looking for. So it was really putting those very important pieces of market infrastructure in place that could then provide that foundation for the market to grow credibly, and most importantly, work towards removing market friction that allows for scale. Since then, we have seen those pieces of work, the Green Bond Principles and the Climate Bond Standard, referenced across the globe in various markets, and also taken into local markets and adapted accordingly to meet the capital market requirements in local jurisdictions. What do I mean is that national green bond guidelines being taken up by Securities and Exchange Commissions that sets the benchmark locally. Because sometimes when we're sitting in various parts of the world and things are happening internationally, it's hard to sort of make that connection. So this next wave of development was taking what's internationally and bringing it home and being able to see how that applies locally and making a few adjustments to kind of make it fit. And we did actually see that in the Nigerian context, where we had the Nigerian government as one of the first sovereign green bond issuers in the world. I think that's a very important point to make here, that this is was a huge achievement made by the Nigerian government and has continued to be a repeat issuer in this space, and had initially set those guidelines locally, of which then the Securities and Exchange Commission took on board to be able to set some guidance to the private sector. And since then, of course, we've seen Access Bank follow in suit with a very successful inaugural green bond. And going back to the point that Vimal had made, which I think is a really important one, is yes, this is about the international capital and the opportunities to see ways of tapping that for the huge investment needs that we are facing across the globe and in our economies. But I think it's also about the domestic capital. It's critical mobilizing the domestic investor base. And, you know, there are opportunities in Africa to be able to do that. And Nigeria is definitely one of those. So the issuances that we've seen to date in Nigeria are all domestic labeled green bonds. And through that exercise has been also the education and outreach to the pension funds to engage the Nigerian investor base on what this is, why it matters. Again, going back to Vimal's point on most of the pensions sit on government bonds. And quite frankly, if you think that's a safe bet today, you are fooling yourself. I have to be quite provocative in that way, because, you know, we are no longer living in a world where government bonds are the safe bet. Because if they are not looking at the non-financial risk of those investments, we are exposed. And so this is sort of the dialogue that has been happening with the pensions, and them starting to understand what other pensions around the world are doing in this space, and how to bring that home and have the assessments of ESG risk at home starts to create that demand locally. And I think that in a very short period of time in Nigeria, we've managed to create that that demand in the economy. So, you know, every bond that has hit the market in Nigeria, and I appreciate we're looking at probably less than, you know, 6-7 bonds. Nonetheless, every single one of them have been extraordinarily successful. So, you know, this is not just something that's happening in Europe and the US and big major markets. This is also happening in Africa. So I think that's something important to note. Just to finish, so, you know, much of the understanding of the developments of the frameworks and what's been happening globally are captured in the toolkit. So it does give the beneficiary a chance to sort of really understand what's out there, what's been working in Africa, and hopefully provides that guidance needed to be able to participate.
Thank you so much for that, Justine. You touched on, I think, part of most directly relating to the toolkit, the issue of fragmentation, going right back to the fact that the investor audience has wanted a way to navigate the opaque aspects of what is green in Africa and how do I go about investing in that. And in creating a single toolkit for the whole continent, we're reducing that level of noise and the rules that abound across the ecosystem. So thank you for, again, focusing the conversation on that, reducing the noise in the ecosystem, and helping more prospective issuers and investors join the conversation. The second part of the point, a critical one made by Vimal, I just want to iterate it again and add a number to it, around the local pension funds and how it is local investors that are playing this game. In many markets across the continent, this is both a sustainability conversation and a financial market development conversation. And in Nigeria, the public markets and the public traded markets make 9% of total GDP, whereas in deeper, more liquid markets, such as South Africa, the South Africa publicly traded markets are 300% of GDP. So the Green Bond Toolkit creates a conduit for people to begin to explore these unexplored markets in relation to how we finance the sustainable and climate resilient growth of the communities and countries that ultimately issue. I think before turning to Q&A, I want to close with, again, a point that was raised by Justine that I really want to iterate. The way in which African markets are working together to come to market to make each of these bonds a realization is something that's explored in the toolkit. But perhaps, Vimal, I'd like to share that it's something that moves the market forward. How the pension players have responded in Kenya to issue that market's first green bond is the beginning of how investors engage and how institutional players seek out green opportunities in new and dynamic ways. Vimal, perhaps before we turn to the Q&A in our final markets, a few words from you again on the Kenyan reality. FSD is actively involved in 8 markets and growing. What more can we expect around coalescing the green bond narrative and priority markets and opportunities for investors on the call and beyond?
Okay, thank you, Anele. So I'll keep it brief. So on the Kenyan case, it was the Econ bond was uniquely structured. It also had guarantees from Garantco, especially for the principal, 50% of the principal, and also two-year guarantees on the interest payments. The reason we are doing is because in order to attract local pension fund managers, I think sovereigns need to look at potential incentives that can be provided, which can attract demand for such kind of instruments. First loss guarantees are one of the example. Kenya, for instance, is the only country, as far as I'm aware, globally that has provided tax incentive on a green issuance, which is again a very big attraction for investors. The Econ bond, again, looking at the pools of capital in the international market, was also listed on the London Stock Exchange under the Sustainability Market Index. So this is also a profile raising not only for Econ, but also attracts international pool of capital. I just read an article today that the European Bank has provided 1 billion capital to Econ's one of the projects, which is now additional capital we are crowding in further on such kind of projects. So you can see that the demand for green assets and green investments is keeping on increasing, and we are having more pools of capital being available for such assets. In terms of new opportunities, so yes, FSD Africa has been working in the African markets. We have supported Kenya and Nigeria. Kenya raising 40 million. We are currently supporting the Kenya sovereign issuance, which is most likely to be issued in the first quarter of next year. In Nigeria, we have raised in excess of 135 million US dollars in total. And the other markets we are right now targeting is Morocco is one of them. Malawi is also a market we are targeting, and we are already in discussions with that. We have Ghana as well, and the SADC region, which comprises of 16 African countries as a whole. So that is where the opportunities are going to come going forward. Kenya also, the private sector is now warming up to the green assets diversification, especially on the pension fund side. So there is also a shift in the mindset of not just investing in the traditional assets, which is government securities, fixed income, and a bit of property, but also into ESG or environmental beneficial assets. So I think I'll stop there for now, Anela. Thank you.
Thank you, Vimal. In the interest of time, I note that I've been so excited. I've not nearly left enough time for the discussion and the opening up of the dialogue. But please allow me to turn to the questions that have been posed by the audience. Tosin, today I will resist answering as I ask, perhaps to both the panelists. On ESG, there's a social angle around interest rates. This is forbidden in some countries in Africa. How will the toolkit address that? Second, forestry is unprotected in Africa. It's a long-term investment opportunity because of a largely listed land. Given the tenors are still limited, what opportunities are there for a startup interested in forestry?
Okay, thank you, Anil. I think I can take the first question, especially on the social angle around interest rates. So we have something called a green sukuk. And sukuk is an Islamic product which takes into consideration the interest rate angle, where it's not socially accepted in some of the African countries to pay or to receive interest rates. So a green sukuk is a product that can also be issued in such a market, whether it's by the sovereign or even by private companies, where the interest angle is not there, but it's taken care of, and you also get access to the green assets investments that both investors and also the issuers are looking at.
Okay, to Vimal, do you want to take the second question, or would you like me to do that?
Okay, so in terms of opportunities, especially in the forestry, which Anela, as you said, is being unprotected. Yes, the opportunities are there, but then the question is, in terms of startup capital, whether green bond will be an ideal asset class. Bonds usually are not used as startup capital in most markets or even in any corporate finance transaction. So there has to be some backing of equity capital, and it can be startup equity capital or venture capital financing, and then eventually the bonds like a green bond can be issued for such kind of assets, because it meets the asset liability mismatches that most pension funds have to look at in their portfolios. And yes, land provides that long-term angle, especially when you look at the tenors. So I think that's what I would say. There has to be some equity capital required, especially if it's a startup, because the bond financing cannot be really used solely as a startup capital.
Perhaps, thank you very much, Vimal. Perhaps biting in on that around opportunities for startups in Africa interested in forestry. Justine did raise in her point around reducing fragmentation. The other side of that is this global call for a coalescing of standards and frameworks around the world. And as we see on a global landscape, people standardize priorities, the taxonomies and standards, as Justine described as a Rolodeck of opportunity. We will see simultaneous regulatory policy response in each of the markets that are impacted. It might not necessarily be happening, the dialogue directly in the finance space, but it's certainly happening across sectors. As we've already shared today, there are multiple themes converging on the question of sustainability. So I'd only say it's a matter of time. Turning to the second question, Andrea asks, how do you see climate bonds working in the specific context of debt-loaded developing countries in Africa and elsewhere? do you see climate bonds having potential to lower debt costs for such countries, lower interest rates to be repaid by sovereign governments, ? Justine, may I let you have a first bite of that?
Yeah, thank you, Nelly. So it's a great question. Thank you, Andrea, for putting that forward. And I believe we also have a similar question coming from Eric as well. So I'll try to tackle sort of simultaneously in the sense of also keeping in light of COVID-19, which Eric puts forward. This is obviously a big question mark and concern, particularly given the debt stress that, as we know, and what the IMF has put out quite clearly, many emerging economies are about to go into. The greatest impact being felt across the emerging markets in light of the pandemic. Also keep in mind, though, that we are about to go through a massive restructuring of debt. And, you know, if that's an inevitable process that will have to happen, obviously trying to access cheaper capital to draw down that debt is the goal. And so I think if I can draw to an example of that, of where CBI was working with the Cabo Verdean government, who was very interested in looking at the opportunity for green bonds more generally. And at the time, you know, the IMF had gone in and done a huge assessment and was very clear that the country was, you know, not in a position to just be issuing any kind of bonds, conventional bonds, and was going through a complete fiscal reform. And happy to report they've been doing very successfully on that. Of course, one of the opportunities we were looking at is, well, in this outstanding debt currently, how much of that could potentially be restructured for green bonds? How much of that asset base is compliant and eligible to, you know, be prioritized for refinancing that can then categorize itself in infrastructure planning, budget planning for Cabo Verde to start building a green bond program that has the potential, after restructuring and refinancing, to be able to access cheaper capital on the international market. You know, something that IMF would look favorably to, especially given the emphasis that the IMF has been making on green and climate. So it kind of plays out here. I think what we're, you know, seeing is this momentum around, you know, the tag phrase, build back better. But, you know, at the end of the day, this is, look, like I said, sustainable finance is an opportunity now during this crisis, unlike any other crisis before, and how we can leverage that to be able to access new channels of capital, potentially cheaper sources of capital, to be able to finance this stuff, to hopefully avoid additional pressures on debt burdened governments. We've just recently seen a sovereign issuance come out of Egypt. Again, not surprisingly, because of the demand in the market, exceptional response with, you know, 10 times oversubscribed. You know, this is the norm. And so the type of pricing pressure that we're seeing, because there's not enough supply to meet demand, you just, you know, you don't, it's not, takes rocket science. You know, we've got a price differential taking shape. So I think, you know, to those point, the opportunity is now. Debt will be required regardless because of the current circumstances that the global economy is in. So how do we get to that 100 trillion? Reminding ourselves that, you know, this has to be, you know, responsible investments that investors will be attracted to.
Thank you, Justine, for touching on that very important point around public debts and really how it's a spectrum of capital that will converge to formulate the right solutions, dropping that cost of financing together with the demand, which is already driving yield compression and the oversubscribed issuances from South Africa all the way to Egypt. So turning to Louisa Meller's question, another very important one. What sorts of incentives are needed to be deployed to stimulate the needed investment response by the private sector across the continent. One that comes to mind is that it is extremely important to build the needed capacity for countries to develop their own guidelines based on best practice to reflect their unique circumstances and needs. Louisa goes on, maybe just to double them up, to say carbon cutter is a realistic, okay, perhaps maybe just the question, that's Louisa's second one is a bit of a solution for all of us, but I'll happy to double back after your responses, Vimal and Justine.
Thank you, Annele. So I think in terms of incentives, and I mentioned this briefly before, so for the African market, Kenya, for instance, provided tax incentives where the interest earned from an issuance of a green bond will not be taxed. I think the other incentive also that African governments or private sector should look at is in terms of guarantees and also the quality of assets. Because as much as there is a pricing benefit, the quality of the underlying assets will dictate the kind of pricing that one can secure in the market, and that is very important. Understanding, so as a regulator, they should also drive understanding and awareness in the market, capacity building being one of them, as you have mentioned, but also it's just not enough because people need to understand the process. They need to understand what a green bond or a green product requires when an issuance happens. And in terms of guidelines, whether they would like to follow locally developed guidelines for each of the countries or even their international guidelines, CBI being one of them, have the guidelines. The Econ bond was actually CBI certified. And that's one of the reasons also that certification earned it a very good profile raising and attracted the additional capital, which the announcement I just saw today. So I think those are the incentives, but also at a sovereign level, it needs to be driven by the governments in terms of encouraging green investments, looking at the SDGs and where we are. So it has to be not only driven by the government, but also the private sector. It's not a one angle play, but both sides needs to play for it to look at the benefits or for it to achieve the benefits that we are looking at.
Thank you, Vimal. And FSD, while a global body, is one that works closely through its network with local market experts and industry experts to bring each of these bonds to market, as we've seen you partner in Nigeria, Kenya, and beyond. Perhaps, Justine, last thoughts from you on incentives for the private sector. CBI does this not only in Africa, but in Latin America and India as well, where you are the head of market development. Close us out on this one, please.
Thank you, Nelly. I think it is very important for being able to set the benchmark locally, the role that regulators can play to help really foster the development of the local market by putting in the guidelines. And this is not something that's complicated to do, and it's a really easy, low-hanging fruit first step. Second to that then is to start looking at, what is the issuer base and potential investor base, and in terms of, the major sort of companies that might be available, or even government, sovereign being a potential issuer. But I think that, again, some of the challenges that may be faced is the size. You're looking at anywhere from 300 to 350 million to tap the international market. So that really does limit the ability to access internationally. For sovereigns, of course, have the greatest potential for that. When we look locally, it's looking at, the perfect example was the Acorn issuance, which Vimal had referred to out of Kenya, which was tied to energy efficiency schools and buildings. And that in itself had a guarantee. So again, coming back to our pensions and moving pension capital, it is about risk. And so that's why, to the points around startups, too risky for a institutional investor at this stage, tried and tested operational assets. And so being able to have, if credit is an issue, a risk wrap around, so the role of a development finance institution, or in this case, Guaranco, being able to take de-risking of that issuance, that's an incentive to get the pensions in. So there's lots of different, and we have mentioned some of this in the toolkit, excuse me, and within that some cases that have been viable in the African market and also forward thinking. I can't stress enough that really sovereigns have a major role to play here. And, Western Africa, if we looked at Cote d'Ivoire, being able to issue a sovereign capability is there. More issues coming out of Nigeria. Ghana has huge potential. Rwanda, continuing to look at the Kenyan market to lead the way. South Africa. This can happen in Africa. And so we are very, very happy to see the launch of this toolkit and hope that we can help further support African markets in realizing the opportunity.
Thank you very much. Ladies and gentlemen, it is 12:04. This has been the launch of the Africa Green Bond Toolkit. We've spoken to you today about the opportunity that is opening up here. We have a single language that enables issuers and investors to navigate the project landscape, select and connect with investors around markets that are forming, the renewable energy prices that are creating a new opportunity for us to gap challenges that have always been around for Africa, around energy, around social housing. So really, thank you, Justine, Vimal, to FSD and CBI respectively, for the Africa Green Bond Toolkit, which creates an opportunity for us to gather around and talk with new rigor and closeness around the opportunity in investing in Africa's green bonds. Ladies and gentlemen, I'm Anele Makwaza. It's been a pleasure being with you, and a good day to you all further. Thank you very much.